In today's video, we're talking about the optimal balance that you should have in your traditional account, whether it's traditional TSP or traditional IRA. For some people, they're going to think that the goal balance is going to be as high a balance as I can get. But remember, different accounts are taxed differently. So it's great that you want to have $1 million or $2 million, but should it be in the traditional account or should it be in a different account? That's what we're going to talk about. And why RMD age? Because at RMD age, you're going to take mandatory distributions from your traditional account. So it makes a difference how much money you have there. And you've got the ability to decide how much of it's going to be there versus somewhere else. So let's talk about 3 different options of what the optimal balance could be in your traditional account coming up next. Hey, my name is Mel Stubbs. I'm a financial planner with Christy Capital Management, where we're helping federal employees plan for a better retirement. One of the biggest expenses in retirement, and in life in general really, is going to be the taxes. And so planning around them can be important. So today we're talking about the optimal traditional balance at your RMD age. Now you can see right here that when your RMD age will be for you. It's either going to be 72, 73, or 75 when you have to start taking mandatory amounts out from your traditional balances. And of course, they're going to be taxed. So what's the optimal amount to have there? Let's look at 3 different account choices that you have to keep your money in. So first, you'll see Roth. On withdrawal from Roth accounts, there's no taxes. The basic tax rate for withdrawal is 0. You'll also see that tax rates during the growth, there are no taxes there either. Then you'll see at the bottom, forced income like mandatory taking out income. The answer is no, you don't have any of that either. So this is kind of the perfect trifecta of what makes Roth so good. Withdrawals are not taxed, growth is not taxed, and you're not forced to take money out, which means the money can stay there and keep growing with its Rothiness, so to speak. Now let's look at tax deferred. This is your traditional TSP, your traditional IRA, and the basic tax rate on withdrawals is whatever your tax bracket rate happens to be at the time of withdrawal. Now you can see there's a 0%, 10%, 12%, and so on. So whatever your income is, it is taxed as regular income. Now what about tax rates during the growth stage? There's none. They are deferred. You don't pay taxes along the way. You'll pay taxes upon withdrawal. And are you ever forced to take withdrawals? Yes, you are. Called required minimum distributions. And that's what we're going to be talking about today. When you show up at the age of required minimum distributions, is there an optimal balance to have? Should it be as large as you can get it? Should there be some planning? Then you'll see there's taxable money. This is a brokerage account, could be a high yield savings account at the bank. Withdrawals are either taxed at your capital gains rate, which you can see here is 0, 15, 18.8, 23.8. If it's a long-term capital gain, you'll get those rates. If it's a short-term capital gain, which means you bought it and sold it within 1 year, it's taxed at ordinary rates, which are the tax bracket rates. So 0, 10%, 12%, 22, and so forth. So it is taxed on withdrawal. Then what about tax during growth? Well, yes, depending on what it is. If you have a CD at the bank, every year that you get growth, you're getting taxed. Or is there forced income in these accounts? Well, sometimes you get dividends. Sometimes you got capital gains where you can't really control it. You just get it, and if you get it, it's going to be taxed. So that's a taxable account because it's taxed all the way through. So just looking at them, if you had to grade them on which is the best account, surely you can see Roth is the best because there's no taxes on withdrawal, there's no taxes on growth, and there's no forced income. So I can argue that Roth is best, but what's the cost of entry? You got to pay something to get the money there. So it's like lots of things in life. Sometimes the best thing usually comes at a cost. And so you've got to decide what's the right cost for you to get your money to Roth. And the cost will be your taxes. What tax bracket are you in? Does it make sense to pay your current tax bracket rate to get it to Roth? That will be up to you, but just based on features of each account by far, Roth has the better features. So you have to have a required minimum distribution based on your traditional TSP or IRA balances. So what's the best balance or amount to have there? Well, option number 1 would be, I don't want to have any RMDs, so I don't want to have any traditional money. So if that's you, between whatever age you are now and your required minimum distribution age, you can do Roth conversions where you're taking traditional money and moving it to Roth each year in hopes of showing up at your RMD age with 0 traditional money. If you're making contributions, you can contribute to Roth, whether it's Roth TSP or Roth IRA. If this is your option, then by the time you show up at your RMD age, you need to have 0 traditional money That way you won't have to take an RMD. Your RMD amount will be zero because you chose not to have any traditional money. If you believe tax rates are going to be worse in the future, then this can be a good strategy. You would want to pay the taxes now while you think they're going to be at a cheaper rate instead of later. You won't have to be forced to take a distribution and thereby pay those higher tax rates. That's the first option. Sorry to interrupt, but if you're watching this video, you're probably thinking about your federal retirement, and there are some important decisions that have to be made at retirement, and messing those up can be catastrophic to a successful retirement. And that's why we wrote the book, Your First Federal Retirement, the 10 decisions that could make or break your retirement. All of these decisions have a lasting impact. Make sure you're thinking through each of these and you're picking the right strategy for you. Get your copy today. Now, option 2 is to have an RMD amount equal to the amount that you need to fund your lifestyle, meaning you would have taken out this money anyway if you weren't forced to. So maybe with your pension and your Social Security, you need to take out $2,000 a month to live at your lifestyle. So that'd be $24,000 a year. You can set it up that when you show up at your RMD age, your RMD amount would also be $24,000 a year. That way you're being forced to take out the money that you were going to take out anyway. One of the things that's bad about required minimum distribution is when you don't need it and you don't want it, but they're forcing you to take it and it's a really large number and it throws you into higher tax bracket. We don't want that. But taking out an amount that you were going to take out anyway is not that big a deal. So there's some planning that can go into this. What balance do you need to throw off an RMD in the amount that you were going to take anyway? That's option number 2. Option 3, let's say you don't need an RMD for your lifestyle. You're living off your pension and Social Security, but you're charitably minded, and so you could have a traditional IRA balance be such that the RMD amount equals your charitable giving amount. Let's say every year you want to give away $15,000 to churches or charities or something like that. You can do what's called a qualified charitable distribution, where instead of writing a check from your checking account to your favorite charity, you can have money go directly from your traditional IRA to charity, and you don't pay taxes on this distribution. So in this example, I usually give $15,000. So let me have $15,000 go directly from my traditional IRA to the charity. You're going to get a 1099. It's going to say you took out $15,000. And you need to have the documented proof that it went straight to the charity, and thereby it's not taxable. So your RMD would not push you into a higher tax bracket because you chose to give it away. Now you can actually start doing the charitable distributions at age 70 and a half, which is sooner than your RMD age. There is a $100,000 a year limit on QCDs, so keep that in mind. If you choose to work with us, we can get the math right to say, hey, when you hit 75 years old and you want to have an RMD of $15,000 a year because that's the amount that you want to give away, then we can do some math to figure that out. And then you can look at what is your current traditional balance? What balance does it say you need to have when you hit RMD age? And factor in some growth along the way to figure out you may need to start doing some Roth conversions to get your traditional amount lower, because just having it endlessly grow and get up to $2 million, let's say, by your RMD age, you're going to have to take out a required minimum distribution of around $80,000 a year. If you don't need it and you don't want it, that could be a large number and could push you into a higher tax bracket. The other great things about limiting your traditional balance by doing Roth conversion is if you're married right now and you're living and filing in the married filing jointly tax bracket, but at the death of a spouse, the remaining spouse is now going to be in the single tax bracket, which is not as advantageous. Now you still have to take required minimum distribution. So those RMDs can actually be more penalizing once you hit the single tax bracket compared to the married filing jointly tax bracket. Getting your money to Roth eliminates RMDs and takes away that issue. If you need help planning for your federal retirement and you realize taxes are a big deal and you want somebody that specializes in helping federal employees get their tax situation worked out, make sure you're not going to overpay the IRS because of poor planning, please reach out to us at ChristyCapital.com. If you want to check out a video about can you Roth convert your RMD? Let's say you don't want to take your RMD. Can you convert it? Well, check out this video right here. My name is Mel Stubbs. It's always great meeting with you. Feel free to give us a call.